Okay, action today in real estate. Today is March 4th, Wednesday, and I'm going to do a deep dive into one town, Marshfield, this town I live in, and then I'm also going to talk on a little bit of what's going on in the headlines, right? What's impacting real estate right now. And the greatest impact we have on real estate right now is probably going to be the Iran conflict, right? So whatever's going on there, my guess is it's going to make interest rates very volatile. And anytime there's any sort of geopolitical tension, it does usually ripple into how people make decisions, right? For whatever reason, and it's a good, valid reason. People just start like, it starts making the gears grind a little bit, right? I almost kind of compare it to whenever there's an election year, just that big tension of like the unknown of what's going to happen, right? Are we going to go into World War III? Is it going to end in 2 weeks? Who else gets involved? Whenever there's a lot of big questions that have big potential outcomes for, you know, just like the future livelihood of everyone on the planet, right? For a degree or another, this is a big thing going on. It kind of gets people to start pausing in their direction. So, what I think is going to happen is interest rates are going to just seesaw for quite a while, go up and down. It's going to be a little bit of a headache as to, what's going to happen with oil prices, what's going to happen with the war. And, I'm saying that all with, I hope that this just ends and we move on and peace happens at some point very quickly. And then I also think real estate wise, in terms of the numbers, and it's hard to really know how it actually translates to it. But I think we start seeing the people like pause, right? Let's list the house now. No, let's give it a little time. Let's wait. It's not quite the spring yet anyway, right? It's just kind of the same thing you see happen around election year, right? When the election comes around, you start getting close to the time where you're going to go start to vote, right? Getting close to the fall, people start getting a little indecisive, right? And then afterwards, all of a sudden, there's an onslaught of inventory and activity and so on and so forth. I think we'll have a similar outcome here. I'll be curious to see what actually happens with the numbers. And again, hopefully it all pans out and goes well. But the big headline that's happening now is just oil, right? So really the impact of this conflict in terms of what is it going to do for the price of natural gas? What is it going to do for the price of crude oil? And how does that impact interest rates? The way that that impacts interest rates is the market sentiment around the cost of energy going up. Will it also cost, will it also cause prices to go up? Because it usually does, right? If it's more expensive to ship something across the country, it's more expensive to sell something across the country. Same with if it's more expensive to ship something around the world, it's more expensive to sell something around the world. So it just makes the price of things go up. So the fear in the marketplace from the standpoint of, well, why would that impact mortgage rates? Mortgage rates are backed up by the bond market. The bond market is a betting market on economic factors. And most of the economic factors that the bond market bets on is how strong the economy is going to be in the future, how strong the economy is now and or weak, and where is inflation, where inflation might go, where wages might go. It's not the same investment as picking a company to invest in, right? You're kind of picking a product, you're betting on like, hey, I think Amazon's going to be a really good bet in the near future. I'm going to put money into Amazon, right? Based on the nuance of Amazon. The bond market's a little different, right? It's a little bit trickier to try to back into that from that standpoint because it's mostly just economic things because it's a fixed asset. So it's something where I'm putting money into it as an investor. I'm getting a fixed rate of return. So the moment I get that fixed rate of return, the risk on that fixed rate of return is mostly inflation, right? It's mostly inflation driven because if I buy something that's going to give me a 5% return, but inflation goes to 5%, I'm really not making anything, right? It's flattening out. I'm not ahead of inflation, right? So whenever there's a fear of inflation, you usually see the bond market react in the wrong direction for what we want to see as consumers, which makes bonds not an attractive investment, which drives up interest rates because the interest rate goes up to try to make bonds a more attractive investment, right? So it's just a supply and demand standpoint. So the value of or the cost of a barrel of oil is going to greatly impact what interest rates do over this spring market. I think if like right now, I think oil was somewhere around $84 a barrel, something like that. If oil gets to over 125, 150, 200 a barrel, don't expect interest rates to be low, right? Expect interest rates to be pretty high if that ends up happening, even if it doesn't start rippling into the actual inflation numbers right away, because the bond market investor is trying to think 6 months, 1 year, 2 years, 3 years, 5 years, 10 years, 30 years, right? They're trying to think as far into the future as they possibly can based on reading today's economic tea leaves. So they're looking at the economy now, thinking about where the puck might be going, and they're trying to skate to where the puck might be going, right? So if they look at barrels of oil and say, hey, a barrel of oil was $60 a barrel and gas was, this much money. If a barrel goes to this much, then gas is going to be this much, energy is going to go here, inflation is going to go here. It changes the sentiment of where they want to put money and what they want to get for a return on putting that money. You're going to see interest rates go up, right? You're going to see 10-year yields go up. You're going to see mortgage rates go up. So that's really the big real estate impact for this conflict, other than the cerebral impact of people making decisions, right? So I think that'll be interesting to see play out. And again, hopefully it just plays out fast. We get to peace as quickly as possible, little loss of life as possible. We just move on, whole world, sings kumbaya and moves on. Like I wish that for pretty much every conflict that's going on, right? But it is what it is. It's the facts. That's what's going to happen. So if oil goes up, rates are going to go up. Now, from the standpoint of Marshfield, moving on to my favorite town I grew up in, let's take a look at some numbers here. So when I do these deep dives for towns, what I'm going to take a peek at is I'm going to take a peek at a couple things, right? I'm going to take a peek at current inventory. And just because of where we are in the cycle relative to, peaks and valleys of real estate, I'm going to do current inventory compared to what did it look like before COVID, right? Because before COVID is really the period of time that the market was normal, if that makes sense, right? COVID has kind of changed the market all around, particularly in Massachusetts, right? I don't know if it's the same around the country. Some of the countries rebounded, but Massachusetts, there was a massive amount of volume in 2020 and 2021. And because a lot of those people bought expensive houses with really low interest rates, that volume of inventory has not returned. And we do not build a lot here. So looking at the data, for example, I'm looking at for sale inventory, and I'm using the website Reventure app. So whatever this is giving me for information is what I'm going off of. And I think it depends on what you look at. You can kind of splice the data differently. But either way, I'm looking at it from a macro perspective of like, how much inventory is on the market. I'm not trying to nail this perfectly. So as of September or August of 2018, there was for sale inventory of 124 houses, right? It's a big number. You go down to April of 2019, which that kind of makes sense because August of 2018, you get a lot of whatever didn't sell in the summertime. And then the fall market kicks in, houses start selling, but no one really puts anything new on the market to a degree or another. Inventory in April of 2019 was 69. That's again how we're going right back into the spring market there. Spring market of 2019, in May, you had 87 houses. And then right before COVID, October of 2019, 83. COVID hits, January of 2020, 38 houses, or that was just a low point there from that standpoint right before COVID. But we were already starting to kind of really get nervous about what's going on. Again, that sentiment's probably starting to kick in of, hey, there's this weird disease going on in China. Should we list our house? We don't know. Let's see what happens, right? COVID hits and inventory just starts plummeting, right? The low point of inventory in Massachusetts is 6 houses, February of 2022, right? So again, 124, August 2018, 6 houses, February 2022. And we have not even got back to halfway the level of the high mark during this cycle. So the past 10 years, right? So the past 10 years, the high mark, 124, 2018, low mark, 6 houses, February 2022. Right now, as of January 2026, 22 houses, right? I know again it's March right now, so the data is stagnant, but I'm not trying to look at it from a standpoint of nailing what's available for sale right now today. Just looking at the macro numbers, right? What does that mean? That means that you don't need that much demand for prices to grow and or be stable in Marshfield, right? Because there's not that many houses for sale. If it's a desirable town, people want to live there with not that many houses, that supply and demand factor kicks in, all of a sudden prices remain pretty stable. And that's about what we're going to see as we look at home value. So as we look at home value here, again, going off of a 10-year mark, not, which the 10-year mark gets us right about to the valley rebound of the '08, '07, '09, mess. If that's the best way I could put it, right? That was the most recent peak in average price was December of 2005. Average home value Marshfield, just call it 450, somewhere in that ballpark. From that standpoint, the low mark was about 2000 and 11, 2012, somewhere there. And that low mark was somewhere around 340, right? So if you bought a house in 2006 in Marshfield, you lost about 100,000 in value in the next 6 years, right? If you didn't sell. Now, if you bought a house in 2006 in Marshfield for 440 grand, you lost value in 2010, 12, whatever. Again, get to the low point there, somewhere around that number. But then in 2014, it starts rebounding, right? We start going up to 350, 380, and then right around 2020, average, 480, and then all the way to now, average price 765, right? And that just directly correlates with as you look at the inventory, right? If you look at the for sale inventory and you look at that data point, right, you can kind of see, prices are pretty low when there was a ton of inventory, supply and demand, the rebound after '08, and then it starts growing, starts growing, starts growing. You would think that, hey, maybe that'd be a good reason for people to sell their house. They're making a lot of money. But if you like living where you live and you don't want to move, and there's not a lot of new homes being built to replenish that inventory, and you're really relying on resale homes, used houses, to keep inventory at bay, but no one wants to move for my interest rate's 2.75. I like living in this town. Where else is available? There's a lot of the South Shore of Massachusetts that is kind of in that boat, if you will, of they like living there. They like their house enough. Economically, the interest rate's so low that they're sitting there like, why am I going to move? My rate's so low. I can't get that in the marketplace and prices are so high. You're just going to see a lot of house flocking. So as we look at that, January of 2026, home value 765. So it valued about 14 years ago at like 330, 340, and now we're over double that, right? And this is something I go over with clients all the time. The risk in real estate is on the short end. It's not in owning for a long run, right? If you even look at historically the past 100 years of value, and you would think by '06, I lost 100 grand in value just doing nothing. Not I did nothing wrong, but the market dropped me a goose egg. And if I bought in '06 and went to go sell in 2012, you lost money to a degree or another. Now, if you bought in 2000, average price was 237, you made 100 grand selling in 2012, right? So it's always relative on ownership. And the longer you own, the less likely you are to lose money if we're just looking at price going up, right? In most desirable towns, particularly desirable towns that have that dynamic of they're already pretty saturated. There's not a lot of room to build more houses. And regulatory wise, they're very strict with zoning, right? So like that's Marshfield to a T. And again, that's a lot of the South Shore to a T, right? There's not a lot of new subdivisions going in where it's like, hey, we got 30 new houses coming in. We got 50 new houses coming in. We got 100 new houses coming in, right? It's just not that happening. So if there's not that happening to replenish it, you're going to see that dynamic play out in any of those towns. If it's a nice town, people want to live there for all the reasons why people pick towns, right? School, location, right? All the reasons why you pick a place to live and there's not a lot of building happening, you're going to see that this almost is a mirror image for a lot of towns across the country that fit that dynamic. And where you're only seeing prices remain kind of flat or even go down are areas across the country that are the opposite of that dynamic, right? Or even they like living there. It's an enjoyable place to live. People like it. All the same economic things. They got a low interest rate, yada, yada, yada. But on the outskirts of town, there's builders building massive amounts of inventory, keeps prices a little bit at bay, right? So from that standpoint, again, just looking at the data, home value has done nothing but go up, go up, go up. And for sale inventory hasn't even remotely got near 50% of what the high mark was during pre-COVID times, right? And in 2019, prices, even with all of that inventory, for sale inventory, 124 in 2018. If we look at home value in 2018, it's not that home values were going down. They flattened a little bit if I'm looking at it, right? So you got, 440 in, let's see, let's go to 2017, August 2017, average home value 428. Then let's go to April of 2019, average home value 457. Not a giant leap, right? That's a decent leap, but nothing crazy. And if I look at 18 to 20, it's kind of actually flat at that period, right? There's really good growth from, 2012 to 2018. There's really good growth there, right? That's where you got back your 100 grand from '06. So, average home value in 2012, 334, average home value in pick a month, 2018, 439, right? So pretty good growth. And then there's a little flattening here in 2018 to 2019 that probably represents the fact there's a lot of houses for sale. So whenever there's a lot of houses for sale, it just flattens out supply and demand. And then inventory gets really sparse starting in 2019. And you just see this as a hockey stick, right? You just see, you know, April of 2020, average home value 474. Let's just go 1 year to April of 2021, right? 557. So April of 2020, 474. April of 2021, 557, right? So pretty good jump in just a 1 year mark that prior to that to get a similar jump, you needed almost 6 years, right? So COVID was just a spike, and it's done nothing but do about that same spike almost every year with very little flattenings and dips. You got a little bit of a dip in 2023 compared to 2022, but I'd even say that's just getting like really cute with the numbers because there was like a little bit of a hesitation in the marketplace from the standpoint of people wondering, oh, a rate's going to go down, right? Oh no, rates are high again. I even said it. I remember I walked into a colleague's office in February or March of 2022 and looked him dead in the eyes and said, interest rates are going to be 3% again before we know it, because there's no way that the economy is going to sustain this high of an interest rate number for that long. Let's see what happens. I was dead wrong, obviously, right? Interest rates have stayed nothing but elevated since then, and I've completely changed my tune as to what impacts interest rates. We live, learn, and grow, right? But I'd say that's, I wouldn't even call the dip from 2022 to 2023 anything real. Average price in August to July of 2022, 652. Let's do, it wasn't even a year, it was into that winter. So the winter going into 2022, 2023, yeah, you saw a little bit of a dip in price. But again, I think that was just hey, everyone's, again, the pause that people take when big things happen in the market. You got to remember the human element related to everything here because all of these numbers are humans, right? I'm looking at numbers here. Humans make up these numbers. Humans are buying houses, humans are making decisions. So you got to add in the human element. And when there's big things happening, humans get indecisive, right? So interest rates going from 3% to 5.5%, 6% in the matter of months. I remember having conversations with clients back then. Just people were saying, hey, when are rates going to come down? When can I refinance? I know I'm getting 5% now. When can I refi? And all those clients that got 5% in 2022 are sitting pretty now compared to where rates have been since then. But either way, it was a lot of people just pausing. It wasn't even that people didn't want to live in Marshfield or that was an undesirable town or there was any sort of crazy dynamics happening. I go to for sale inventory for the same period of time, up a little bit from 2022. Again, 2022, February, that's when rates were really going down. Indecision or really going up, right? Rates spiked starting January of 2022, and the low point for inventory is magically February 22, right? Bad timing, winter months. No one usually wants to list then anyway. But then you also get that indecision factor of being a human, of you sit there with your realtor and you're saying to your realtor, hey, we want to move, we want to sell our house, but interest rates just went from 3% to 5%. What should we do? Should we wait? Should we just changes the whole conversation, right? It's probably a lot of that going in. And then all of a sudden, probably starts normalizing. And then just go a few months forward, June of 2022, inventory's at 33, right? Tripled between February of 2022 because the market started saying, hey, you know what? And even with me, rates are probably not going to come down. Rates are just, this is probably where rates are going to be for a little while. So then all those people that were like, let's pause, see what happens, were like, hey, you know what? Let's just move. Let's move anyway. So you saw that anyway. But then again, 2023, February, low point 11. And I will say the best part of what I'm seeing in these data points is the lows and the highs have started to balance out, right? The low point of 10, low point of 11, and then we go through the cycle of the year again into the winter and the spring, low point of 17 for March of 2024, and then low point of January 2025, 18, right? And now low point January 2026, 22, right? So the lows have started balancing out and going higher, and the highs have started balancing out and going higher, which that shows to me. Again, if I try to look at the numbers and think like a human, people are getting off the fence and starting to move and starting to say, hey, our rate is really good, but we want to move for this reason, whether we're staying in Marshfield, we're moving to a different town, or relocating. It's finally time to start doing it. That's what I'm seeing in those data points, right? That the indecision factor of the human element of these numbers is starting to play out to say it's time to just make a move. We've been waiting, we've been waiting, we've been waiting. Our life can't wait because every time we wait, a day goes by, and every day that goes by, I get older and I get further away from, you know, the goals that we want to achieve as a family. Like again, all the reasons why do people move? It's not because of money. People aren't moving. Money matters, but if it was only money, everyone would be selling their house right now. Because if we look at home value, if I look at the home value again, if I just owned a house for 10 years, 2016, 392 average price, 765. I've almost doubled my money. It's pretty damn good. You would think if it was only money, we would see a crap ton of inventory, but supply and demand. If there was a crap ton of inventory, would the prices be there, right? People don't move because of money. Money matters because you have to still buy a house you can fit your budget into, but people move for all the people reasons, right? Having another kid, got relocated for work. Unfortunately, grandma passed away, and we're gonna go buy her house, right? Like whatever it is, moving is most of the time a human thing. So if I'm looking at for sale inventory and I'm trying to extrapolate out from the data what's going on with humans based on this data, it's a lot of indecision with the economy, what's happening, what a rate's going to do. And the further we go along in time here, the more it's playing out that people are starting to see, hey, I have no control over the data. I have no control over what rates are going to do. I have no control over what home prices are going to do. And if you talk to a realtor, you talk to a financial advisor, you talk to a lender, you talk to an attorney. I just had a conversation with a client about this the other day, and I used the analogy that, you know, I can't control the weather. And if I try to control the weather, I'm going to drive myself crazy, or I'm going to be a shut-in in my house. If I'm afraid of rainy days, I'm never also going to experience sunny days because I'm just going to stay in the house because I have no idea what the weather is actually going to do. Weather people don't even have an idea of what the weather is actually going to do. Talk about a good job, right? You get to guess as to what's going to happen. I wish I could guess as to what's going to happen and hope it worked out. Can't do that though. But again, at the data, the lows are getting higher and the highs are getting higher. Do we get close to the range that we were in pre-pandemic? I think it's going to take a long time to do that. And I think it's going to keep most likely playing out that way, that the lows get a little higher and the highs get a little higher until it starts really balancing out. But what does that mean for you? Does it mean when's a good time to buy in a certain town, right? I'm going to give you my answer. That is a horrible way to approach real estate. If you're buying a house to live in, you shouldn't be looking at timing of these numbers. If you can afford a house, it is what it is. You cannot time real estate. You can hold real estate for a long time and remove risk of losing money based on ownership duration. But if you're trying to time real estate, you are now a real estate investor, and a real estate investor thinks completely different than anyone who's buying a house to live in. It's not the same mental gymnastics. If you're buying a house to live in and you're also trying to time the market, you're probably driving yourself crazy. And if you know anyone like that, or it's you, I'm probably hitting the nail on the head because you're sitting there and you're like, when is Marshfield going to be cheap again? When is Marshfield going to be 350 grand again? That's when I'm going to buy. And now you've probably been sitting there for the past 5 years thinking, eventually it's going to be 350. It's going to crash. Don't worry. You're missing the boat on what real estate is. Real estate is not a money thing because I just explained money is not the motivational factor as to why people sell houses most of the time. Because if it was, everyone's house in Marshall would be for sale and we'd all be living in hotels. Not the case though. People live in houses because they like the town, they like the location, they like the view, they like the layout, they like the neighborhood, they like the neighbors, they like the school district, right? Whatever it is, money is not the motivational factor for most people buying and or selling real estate. And if you're putting yourself in knots trying to time rates, time values, and you're someone who can qualify in today's market, right? If you're trying to time your life around like, well, I can't afford anything right now, that's a different dynamic. You got to keep working on your career, you got to keep making more money, saving money. There's nothing the market's doing that's going to help you there, correct? Because if the market crashes, you might lose your job anyway, right? So from that standpoint, what you should be looking at is making sure you just buy a house you can afford and having it fit square peg, square hole into your budget really neatly. And if you qualify today to buy a house in the town you want to live in, but you're putting yourself in anxiety because you want to make sure that you look at charts like this that I'm looking at and go, oh, look, in history, I made the right decision, then real estate might not be for you because you have no control over the weather. So if you're looking at the weather and going, you know what, I'm only going to do things when it's nice out. I'm never going to leave my house when it's a rainy day. I'm never going to leave my house when it's snowing. I'm never going to leave my house when it's cloudy. I'm never, good luck. You're not, you're going to have very few sunny days unless you move to San Diego. San Diego is very expensive, I think. So from that standpoint, that's today's action in real estate. And I'm Mike, signing off.